Okay, I see some familiar faces out in the crowd. Just by a show of hands, who was at the Urbana, the Urbana AGM and heard me speak? Okay, so a fair number. So apologies if there's any duplication, but we'll go into some more depth today. Okay, so FundThrough's mission is to help small businesses thrive. And we do that by reimagining invoicing so that businesses can get paid instantly. This is one of the biggest pain points for small businesses, which is they've delivered the goods and the services to their larger customer, and their larger customer doesn't pay them right away. You know, back when my grandfather was working, he was manufacturing coats, and he would manufacture a coat, somebody would come and buy the coat, and they would give him $1, and he would give them the coat, and they'd go their merry way. Somehow it became this social norm that I'll give you the coat, and you give me the $1 later. Later was 10 days, then it became 30 days. Now the average across Canada is 60 days, and it keeps getting longer. Every time there's a financial crisis that, or an economic downturn like we're entering right now, that time period gets longer and longer. But what's weird is that it never gets shorter, during the boom time. So that means that these small suppliers are often acting as a bank for their much better capitalized customers. It's not that their customers necessarily need to hold on to it, but they do so for their own benefit, for their own management of their own working capital. And it turns out that there are different components of small businesses who are selling to companies. There are those that are selling to large companies, there are small businesses that are selling to other small businesses, and there are small businesses that are selling to consumers. Well, a small business who's selling to consumers or is selling to other small businesses has a little bit more control over when and how they get paid. They could send a credit card link to their customer and ask them to pay by credit card. But if you did that when you were selling to Walmart or to the government, they would laugh at you. They don't pay by credit card. And I know you're all sitting down, so I don't want to shock you, but mostly they still pay by paper check. And that paper check means, the check is in the mail, takes even longer. And then oftentimes for small businesses that are punching above their weight and selling to much larger customers, that also means that they're getting big checks. What happens to a small business who goes into a bank and tries to deposit a big check? The bank holds on to their money for a long time. So that means it even is a longer gap between when they can get paid. We're creating a new category. So as I said, small or small to consumer have a solution and they can accept credit cards. We're creating the rails to be able to be that solution for small businesses selling to much larger customers. Because when they sell to large customers, most of the value in the economy of invoicing is small to large, even though most of the volume is small to small. Most of the transactions happen in small businesses selling to other small businesses selling to consumer. We chase the money. We don't chase the transactions. So instant payments, control, leveling the playing field, enabling a small business to decide when they are going to get paid and not their customer. So ultimately, our goal is to be right in the middle of it. In order to be right in the middle of it, that means we get in the middle of the ERP system, which is sort of the source of truth, if you will, the brains, the management system that they use, in the middle of the buyer, in the middle of the supplier, who is ultimately our client, and in the middle of the capital provider. This makes it easy because ultimately a small business doesn't want to have to go to multiple different sites or multiple different sources to get their work done. Our strategy is to be embedded directly in the workflow of the small business so that they issue an invoice and then a button pops up right in their QuickBooks or in their invoicing platform in their niche category, whether it's oil and gas or staffing or manufacturing. There are all these great software programs out there that service these individual niches where the thing that they're missing is the ability to actually get the small business paid. That's what we do. So you never have to leave your workflow. You issue an invoice, a button pops up that says, do you want to get paid faster on that invoice to an approved customer? All you have to do is push that button. FundThrough will fund it. We will wait on your behalf and get paid by your customer when they usually pay on whatever those contractual terms are. You get the money today so that you're able to then grow. The way we go to market is by embedding with these types of partners. So with QuickBooks, we have a partnership with Intuit Canada. It's going to be expanded into Intuit USA. We have a partnership with Inveris, which is an oil and gas invoicing platform, and a bunch of other ones where we get embedded directly into the platform, as I said. Well, this is a win-win. We hear on the slide we have it as a win-win proposition, but I would say that it's actually a win-win-win proposition. Obviously for FundThrough, it's a winning proposition because we don't have to market one-to-one. We don't have to find individual small businesses by taking out bus ads or radio ads or TV commercials or whatever. We can go to the masses by going through the partners who have all of these small businesses. To the partner, it means that they can make their user base more sticky. So they can offer services that will keep them within their platform, and they can generate high margin revenue along the way, because the way our business model is, instead of paying for the bus ads and the radio ads and the TV ads, we will pay the partner on a variable basis based on when funding happens through our platform, which of course for them is very high margin. They don't have to do anything. So it's a new revenue source for them, makes their user base sticky. And the third win is for the client themselves, for the user. The user never has to leave. They know it's simple. They can fund any invoice they want to an approved customer. They don't have to fund all their invoices. They don't have to fund all their customers. They use it when they need it, and they only pay for it when they use it. So Urbana invested in us back in March of 2020, and just a quick story that I'm very proud of the Urbana team, Brendan and Tom and the whole team. We closed this transaction, the initial equity investment, on March 12th, 2020. And I don't know if anybody else knows anything else that happened on March 12th, 2020. But that was the last day that I ate lunch celebrating the closing of this transaction in a restaurant for many, many years. But what it is a testament to the type of investor Urbana is they take a long-term approach. There was never any discussion about delaying closing. They knew that this was a service that was going to be necessary even through the pandemic, and it was. We grew quite well through the pandemic, and now we're reaping the benefits. Just the latest that we have, this was through our year-end June. 180% growth, profitability from burn, and we're only going forward. The interesting thing is we're sort of built for this time. It's a weird time. We all know that. Just today, interest rates in Canada went up by another 0.5 point. Never in my lifetime have I seen a potential recessionary environment at the same time as inflation and interest rates going up. Usually one happens and then the other happens, but not two at the same time. So that's a weird time. In our business, in a recessionary environment, large customers take longer to pay. Other financing sources dry up. That need gets wider, and we're here to serve that need. So this is a time where we can thrive. Now, we have to manage things like our own cost of capital going up and the availability of capital, but we're seeing record demand right now, and some of the things that we're focused on is bringing more capital to bear to be able to serve that demand. And when I say record demand, I mean record quality demand. The thing that you want to make sure about in this environment is our small businesses, is the risk of the small business that's coming onto your platform increasing, and therefore something that you want to tighten your funnel. We are tightening our funnel, but the beautiful thing about our model is that our risk is on the end customer. So we know that end customer is ultimately going to pay the invoice. What we don't necessarily know is when, nor does our client. But we try to take the risk of our small business client out. So they could be a new business, they could be a small business, they could be an asset-light business with a light credit history or a thin credit history, and it doesn't matter if they're selling to really high-quality customers. We can do that, whereas others, may not be able to. So this is actually an interesting environment for us to operate in, and one that I'm excited about. I think that we can get through this. We can make it actually quite strong, because the competitive landscape is suffering, and this is a way for us to really drive through it and come out of whatever period we're in much stronger, whether it's 6 months or 2 years, it doesn't matter. So we have a lot of growth opportunities here. As I said, we're experiencing record demand just through our existing channels right now. Something happened over the last 2 years, and all of a sudden, we started getting a bunch of inbound interest on these business-to-business marketplaces and these invoicing software platforms for us to embed in them. Previous to that, we would be knocking on doors saying, "Hey, we've got this really great service. Do you want us to to talk to you about partnering?" And they say things like, "Yeah, it's interesting, but I've got this other thing on the go, or it's not quite yet on my roadmap." All of a sudden, when they realized, certainly during the pandemic, that they were looking for higher margin opportunities, they were looking to keep their user base sticky, they've come to us. So we've got a pipeline of more than we can handle, quite frankly, of partners who want to work with us, who want us to embed. And in order for us to do that, we have to now do it sort of sequentially instead of doing them all at once, just because we ourselves are resource constrained. We're busting at the seams here. At the same time, we're looking to expand and deepen our existing partnerships. I talked about the fact that we have Intuit Canada as a sort of anchor partner for us, and that's a great partnership for us. They've introduced us to various of their other geographies, including, obviously, the Holy Grail, Intuit USA. And now we're working with them to expand there. They also want to expand into the UK and Australia and all these different areas, while also improving the utilization. So at each step of the funnel, we want to get conversion greater so that we can increase the utilization at the end of the funnel within our existing partners. Same with, we've got a great partnership with Inveris, which is in the oil and gas space. Obviously, we're riding the wave of strong oil and gas pricing, which gave us the cover to be able to actually find the messages that work, the users on their platform that work, so that regardless of where oil prices are, we would succeed. And then, of course, looking at our loan capital to ensure that we're competitive in the way our structure is. We're always looking ways to both reduce the cost of our loan capital, despite the interest rate environment that we're in, and a structure from a treasury perspective that can add value to our company. Once we get these clients in, they really like us and they're really sticky. So we look for ways to, just as Richard was talking about, transfer over from sort of transactional revenue to subscription revenue or recurring revenue. What are the services that we can provide to these clients within the focus area of invoice funding that is of value to our clients and for which they are willing to pay? So we have a bunch of experiments out there that we're looking for. So I'm going to stop on this slide and then open it up to questions. Where can we use your help? Some of you may already be Urbana shareholders, in which case you are indirect shareholders already of FundThrough, and our success will ultimately be your success. Others of you might be looking at an investment. My ask to each of you is to help us build awareness of FundThrough. One of the things that we don't have is a multi-gazillion dollar budget to take blimps out so that everybody knows about FundThrough. We rely on groups like this, because I can promise you everybody in this room knows somebody who runs a business who has this cash flow challenge and is of none of their doing. It is just the circumstances in which we operate. So recommend them to FundThrough, please, and we can certainly help them. You may know of different partners who may want to either partner with us or have us embed with them, embed with them. And certainly investors, we're always looking for equity investors, loan capital investors. And then the last one is talent. It's always great to get our name out there. We have job descriptions that are on our website, but more importantly, I love talking to smart, talented, motivated, ambitious people. And we will find places for them as we are growing. So if you know of anybody who is interested, please direct them my way, and I'm happy to either have a chat with them or introduce them to our talent team. But most importantly, scream from the rooftops, like FundThrough, FundThrough, FundThrough. We will bridge that gap for small businesses invoicing much larger customers and having to wait to get paid, so that we can level that playing field for them and put the control back in the hands of the small business, which we know is the engine of the economy. So I'm going to pause there. I'm going to stop there. I have 13 minutes left, and I'll open it up to questions. Yeah.
Find out. Thank you very much for the presentation and the enthusiasm. FundThrough, FundThrough, FundThrough. How am I doing so far?
Everybody say it 3 times.
Everybody now. How are you different from traditional bridging funds, bridging finance shops, and especially going into the U.S. There are certain times when this business looks really attractive, and then people get burned. How do you manage through that? Because then people default, and then there's chargebacks and so on. How do you manage that side of it, and how do you compete against traditional bridging people?
So on the first question is how do we compete against traditional factoring companies, and the second question is about the U.S. and how we're going to perform in the U.S. So I'll answer the first one first. As a technology-first company, we approach the problem from a different mentality. The way I got into this business is that I was originally going out to buy a business, and I was talking to a bunch of small businesses. They told me their problem, and I said, hey, wait a minute, I might be able to solve that. I went home, I thought I was brilliant, I did some research, and I was like, oh, wait a minute, this has been around for 1,000 years. So now I joke that I'm really good at coming up with ideas that already exist. But they were very manual. Existing factoring companies still use fax machines. They still require you to fund your whole book. They still require you to somehow get them the invoice and the verifications off the platform that you are using on your daily basis. Where we will be able to compete and win is that we will be the one who embeds directly in your platform. That button, it's hard to understate how important having that button and those partnerships is to our ability to go out and fund. 95%, don't quote me on that number, of our users had never heard the term factoring, don't think that they are factoring. All they think that they're doing is getting paid faster because they push that button. That's unique. That's different than what other factoring companies out there are able to do. As far as the US goes, so I should have actually stated in here, about 85% of our revenue is already in the US. We made a major acquisition last year that was a highly accretive, highly synergistic acquisition. Before that acquisition, we were still 60% US, but after that acquisition, we're now about 85% US revenue. So we know that market, we know it fairly well. What I would say is we launched in 2014, and we have seen a lot of shiny objects come and go in the 8 years that we've been doing this. I often will say that we feel like we're the tortoise in the hare story. In 2014, 2015, FinTech 1.0, investors would say to us, well, why aren't you doing this? Direct mail, why aren't you doing that? And I'd be scratching my head and saying, I don't understand how it works, but Silicon Valley's throwing a lot of money at these companies, and they're smart folks, they must be doing something right. Well, sure enough, they blew up. The OnDecks of the world, the Cabbages of the world. If any of these names mean anything to you, none of them exist anymore. Then, as the years went on, there would be the new thing, buy now, pay later, whatever it is. And we would just methodically continue to build our business. This is not a business that has ever grown 500%. It's not a traditional sort of VC business in that it's growth at all costs. Why? We could do that. It's very easy to grow revenue. If you're going to be valued off of revenue, which we are, I can grow revenue. It's so easy. I just have to throw money off the CN Tower. Anybody will take my money. The trick is getting it back. And having a robust foundation and a robust risk management platform, I believe, builds a business for scale. A lot of the US players, because there's so much money out there, it takes them they take the money and then they have to grow into it, and they take these risks that I just don't believe are true. Like, losses can't be 30% of revenue. It just doesn't make sense. Losses can't be, marketing can't be 120% of revenue. It's not sustainable. We're building a sustainable business, and I think that is ultimately going to create value.
It sounds like the cost of client acquisition is going down. Would that be a correct statement?
I would say the cost of client acquisition, the way we look at it, yes, it's certainly going down as we get scale. But what I love more than anything is when it's variable. I don't mind paying when I fund a client. What I don't like is buying something, Google Ads or something, and not knowing that I'm going to get a payoff at the end, and then I have to include all of that when I amortize that, my total marketing cost against the clients. Here I know I'm letting my partner do the work, and when they do the work, I'll give them a vig.
So you're aligned.
Yeah.
So then you're starting to be profitable. What is how much capital do you have to put down for $1 of funding? So what's the ratio in terms of capital to funding?
Yeah, so a couple things about being profitable and getting there. So one of the things that I am proud of is in US dollars, we've only ever raised $20 million in equity over the 8 years. We've translated that $20 million of equity into a business that currently has $35 million of revenue and is profitable. Or teetering on profitable depending on the interest rates, but was profitable the last couple of months and will be as we deal with the interest rate hikes. So our model with our loan capital is we have facilities out there that are, call it senior facilities, and then we have sub-debt, which is really friends, family, high net worth individuals, family offices, lots of different groups. So the senior will fund some percentage, anywhere from 85 to 95%, and then the junior will fund the rest. We do have this equity cushion that is required, but the profitability in our business creates this virtuous cycle in multiple different ways. One is the more profitability you have, the lower your loan capital pricing will ultimately be. And you have the ability to capture your own margin because you can use your own money to lend out, and I don't have to pay anything on that. So that's higher margin. And you create that real virtuous cycle, and you get the flywheel going. We're not quite there yet. We're probably 6 months to a year in, depending on what the macro environment is, to be able to get that flywheel really spinning. But we're well on our way.
So one more capital raise.
Pardon me?
So one more capital raise to go.
Well, when we raise equity capital, it'll be to, in this environment, maybe we'll do an equity raise just to solidify the balance sheet and have that fortress so that we come out of this downturn as really the winner. But ultimately, the next capital raise, beyond maybe like this interim one, if we end up doing something, that ultimate next one will be because we want to, not because we need to. It's not to fund operating debt. All these tech companies in the public markets and in the private markets that aren't profitable, are getting slammed. We knew that in our business profitability created that virtuous cycle, and we knew that it was important. So we focused on this even before even before 2022. But as I said, when we have this pipeline of partners coming in, looking to partner with us, and we can only do each one sequentially instead of doing multiple at a time because we only have so many resources internally, it may make sense to actually do a large fundraise to be able to take market share and really become that winner.
So, Stephen, thank you. I guess two thank yous. One is for having shared Urbana's investment philosophy, which we entitled "What Could Possibly Go Wrong." We refined that over the years because it was the spring of 2008 before we invested in CSE for the first time. So, to the man who was asking me, who's worried about oil prices, no. but I am worried about the next time we make an absolutely world-changing investment, like the CSE or FundThrough. That's when you know the market's topped. It's just nice that we've been able to get it right down to the day.
Yeah.
But I will say thank you in this. I have no question. I just want to say thank you in this. So for those, as to your building fans, I had a friend, a very good friend for the last 40 years named Doug, who called me up and said, Brendan, my furniture is in here and offshore and thing. He had a huge receivables problem. Brendan, can you help me?
Yeah.
No, I can't. But I have a friend named Stephen at a company called FundThrough. Put them in touch. Stephen looked after him. My friend's business was gone if he didn't get some help. You figured out how to arrange it, and I'm just very grateful for that. That's the kind of work they do at FundThrough. Yeah. Just keeping businesses that have been alive for decades that this whole supply chain business has really crushed. You've made things possible that wouldn't otherwise be possible. So thank you.
Well, thank you. And I'm sure others have stories like that as well, so we can help them too.
Hi. The nature of my question is credit risk, and I want to get this right. I want to describe it right because it's going in a couple of different directions. Your credit risk is not your client. Your credit risk is your client's clients.
That's correct.
And the nature is, how do you evaluate credit risk? And I'm going to offer two possibilities. As you said, 95% of the invoicing from a dollar term is from 5% of the number of invoices. But what's to keep your client from pressing FundServe every time for that 5%?
Yep.
So you end up with a bunch of tiny little invoices, which is a headache for you, but also much higher credit risk.
Yeah.
And the second question is, what if they pull a Target Canada on you?
Uh-huh. Yeah.
So those are the two questions.
So for the first one, again, one of the beauties of us being a tech company and having data in our as part of our core offering is that we can determine when that button shows up and when it doesn't show up. So it will only show up.
It only shows up at a certain time.
Right, because we have a full partnership with the platform. In this case, it's QuickBooks. We get visibility, we get the data back and forth. We've got what's called APIs back and forth between them, so we can pre-approve end customers, and we know if it's a pre-approval, we'll put the button on. If for some that's not foolproof though, some might come on. We do have thresholds, so we will fund an invoice that's less than this or a cumulative amount of this, and you have to see a history. One of the beautiful things about credit risk in our business is that we have these platforms where you can actually see that the invoice itself is going to get paid. Because as I said before, we don't take performance risk, we take time risk. So I want to make sure that I know that the client is actually going to, the end customer is going to pay. These platforms, the software allows you to do it. When you put an invoice in, you can see that an invoice has been accepted, approved, in queue for payment. Target Canada would be a black swan event. That is one that we would have been exposed. We would have had exposure the day before Target Canada went out. We just didn't happen to have any clients at that time who sold it. How do we mitigate that? Well, we have security over our clients to ensure if ultimately, because we're only taking time risk and not performance risk, if an invoice doesn't get paid, we will put it back to you and require you to fill it with us, with another invoice or with cash. If you don't have the ability to do it, we also have a credit insurance wraparound, which we would have had for Target Canada, so we would not have gotten burned. So that is our black swan insurance, is this credit wrap that we have around it, the credit insurance wrap. I see Liz is on the edge of her seat, but I will stick around. Charlie?
One last question. What has your credit loss experience been?
To date, our credit loss is about 0.4% of capital, and we funded almost $2 billion.